Okay, good evening, everybody. I want to welcome you to SC Online Revision class. If you can hear me, can you just put it up on the chat button before we start? Okay, Mr. Gibbs, thank you. Rabiat, thank you. All right, we're going to start straight away. Obviously, there's no time on our side, and I think this is 7:02. We've given about 2 minutes grace for everybody to join. The last time we met, we talked about impairment of assets, and obviously, I think we should be able to handle questions around impairment, and when it comes to cash generating unit as well. And from there, we take a look at IFRS 5, assets held for sale, and of course, discontinued operations. And we gave some criteria before an asset that can be classified as held for sale. And the measurement criteria, we said assets held for sale are measured at the lower of their kind amount and fair value are less cost to sell. And we also said whenever an asset is held for sale, they are subject to annual impairment review. They must be represented separately on the face of financial statements, and of course, they are no longer depreciated. And we also moved to discontinued operations, where we said a discontinued operation is a component of an entity that has either been disposed of or is classified as held for sale. Okay. Today, we are going to take a look at IAS 10. The standard is quite important because of what is happening around us. That's COVID-19 pandemic. So in the next 15 to 20 minutes, we'll deal with IAS 10. I'll just give you, just go straight to the point on what you might expect from the examiner if they decide to test your knowledge around IAS 10. And from there, we move straight away to IAS 41, which is also very important. That's agriculture. And if time will permit us, I'll introduce us to IAS 21. That's the effect of changes in foreign exchange rate. Of course, from the material you have with you, you also have IFRS 16 leases. Okay, so maybe the next time we're going to take a look at that. But let's deal with what is before us. That is IAS 10, events after the reporting period. Okay, so naturally, I'm going to assume zero knowledge, so I'll just come down to the very basic, okay, so that we can all be on the same page. So like I said, permit me, about 15 to 20 minutes, I'll be done with IAS 10, okay? Now, when you say reporting period, what does that mean? It simply means the financial year of a company, or you say the accounting period of a company. So for example, if the start of my accounting period is say January, so that means I'll say my reporting period is January to December, okay? Let's say 2019, as the case may be. So it's also possible the start of my accounting period is, let's say October. So that means October to September the following year. That's my reporting period, okay? Then we have what we call authorization date, okay? We have what we call authorization date. What does that mean? Authorization date is the date at which financial statements are authorized for issue, okay? So when an entity prepares financial statement for a particular financial year, say January to December 2019, then there will be a time that is going to be authorized for issue. So that means they can take it to the public, for example, especially for a public limited liability company. Okay, so naturally or usually it takes 3 months after the reporting period because the external auditor is going to work on it, and 3 months after, is going to be authorized for issue. But for the purpose of the exams, the examiner can say 3 months, 4 months, 5 months, just follow what the examiner is saying. But in practice, in most cases, it's usually around 3 to 4 months, where financial statements are authorized for issue. So don't forget, we needed to understand balance sheet date, which in this scenario I'm going to give is 31st December. Then authorization date, if it's going to be 3 months after the reporting period, that's March 31st, 2020. So let me use 2019 as a case study, okay? So we have January to December 2019. Then the authorization date is going to be March the following year, 2020. Okay. Now, what's now the issue around event after the reporting period, IS10? Okay. Now, what does that mean? It simply means events after the reporting period are those events, both favorable and unfavorable, that occur between the end of the reporting period, but before financial statements are authorized for issue. So let me say that again. Events after the reporting period are those events, both favorable and unfavorable, that occur between the end of the reporting period, but before financial statements are authorized for issue. So whenever you see IS10, okay, whether in practice or in your question, in your exam scenario, all you need to understand is, I've told you earlier on in our first class that date is very important when you are dealing with financial reporting or corporate reporting or SBR, as the case may be. Date is very important. Whenever a transaction or some event occur between the end of the reporting period, but before financial statements are authorized for issue, then is within the reach of IS10. If it occurs within the reporting period, IS10 will not apply. If it occurs after financial statement has been authorized for issue, IS10 will not apply. So that's what you need to understand. So that is event both favorable and unfavorable that occur between the end of the reporting period, but before financial statements are authorized for issue. Then we have two types of events, okay? We have two types of events. We are used to my style of teaching, I think I mentioned it in our very first class. I don't really like to look at the material, when I lecture, okay? So that I can flow, I can really express myself when I lecture. So I don't look at material, but don't be. So that means what I'm saying sometimes may not really correspond with what you have on your screen. But if I needed a soft question, obviously, I'm going to show you that screen. So, but just listen to me and understand everything I'm saying is there in your notes. So we have two types of events, okay? We have two types of events. Now you need to listen up because these two events happen after the reporting period, but before financial statements are authorized for issue. Two types. We have adjusting events and non-adjusting events, okay? Now, the reason why I'm bringing on IS10, naturally, I don't really take corporate reporting class, is because of COVID-19. So let's brush our mind around that in case the examiner is giving you a case scenario. Okay, so we have two types. We have adjusting events and of course non-adjusting event. Now the question is this: what is adjusting event? What is adjusting event? According to IS10, adjusting events are those events that provide further evidence of condition that existed at the balance sheet date. Adjusting events are those events that provide further evidence of conditions that already existed at the balance sheet date. So let me give you a scenario. So let's say as of December 2019, I recognize receivables of 200 million. For example, the 200 million I recognize, some of my debtors or let's say customers are owing me. I sold goods to them on credit. So the sum of that money is say 200 million, for example. So one is owing me 15 million, another one 50 million, another one 10 million, another one 5 million. Everything makes up 200 million as at the balance sheet date. Then around January 2020 or February 2020, I received an information that one of my debtors, that's my customer, that is probably owing me around 20 million, has been declared bankruptcy. Can you see now? It has been declared, he or she has been declared bankruptcy. That means he cannot pay that money again. It provides further evidence of condition that already existed at the balance sheet date. The amount this customer is owing me already existed at the balance sheet date. Then in January, before financial statements are authorized for issue, I got an information that the customer can no longer pay because he has been declared bankruptcy. Okay, so what does that mean? I have to go back and adjust. That's why they call it adjusting event. I have to write off that money. I have to credit my receivables and debit bad debt or debit my profit as the case may be, because I cannot recover the money again. So it provides further evidence of conditions that already existed at the balance sheet date. So according to IAS 10, adjusting event will require the figures in the financial statement to be adjusted for. Okay. So let's take a look at the second one. That's non-adjusting events. Okay, non-adjusting events. Now, what is IAS 10 saying around here? Those are events, non-adjusting events are those events that are indicative of conditions that arose after the balance sheet date. Okay, they are indicative of conditions that arose after the end of the reporting period. So that's what we call non-adjusting event. They are indicative of conditions that arose after the end of the reporting period. Okay, sorry about the breaking transmission. Sorry about that. Okay, so we can continue. Okay, so as I was explaining, non-adjusting events, they are indicative of conditions that arose after the end of the reporting period. Okay, they did not exist at the balance sheet date, but they are indicative of conditions that arose after the end of the reporting period. For example, after I prepared my account around January 2020, don't forget, we are given a scenario around the, let's say my accounting period is 1st January 2019 up to December 2019. So in January 2020 or February 2020, I dispose a subsidiary, a major subsidiary. Okay, I sell it off. That is an example of a non-adjusting event because the sale did not occur or did not exist at the balance sheet date. It is indicative of condition that arose after the end of the reporting period. It's also possible that I dispose major assets, okay? I sold off major assets. It's also possible that a fire got one of my plants and machinery, okay? That fire did not exist at the balance sheet date. The value of the asset remained intact as at December. So that's why when you prepare your financial statement, that's your financial position. You will say, statement of financial position as at 31st December. Okay, so fire now got one of my plants in February. So that is not an adjusting event. It's a non-adjusting event because it's indicative of condition that arose after the balance sheet date. And according to IAS 10, a non-adjusting event only require a disclosure as a way of note in the financial statement. A non-adjusting event only require a disclosure as a way of note in the financial statement. Let me say that again. A non-adjusting event only require a note, okay? Only require a disclosure as a way of note in the financial statement. So when you're doing that, you are disclosing the financial effect. That's the estimate of the financial effect of the event, okay? Estimate of the financial effect of the event, and of course the nature of the event. So that's what you're telling. That's what you're telling the users of financial statement: the nature of the event and the estimate of the financial effect. So that's what you're saying. However, now listen up. However, if a non-adjusting event will impact on the going concern of an entity, if a non-adjusting event will impact on the going concern of an entity, it becomes an adjusting event. So what's going concern? Going concern is the ability of a company to exist in the foreseeable future. So if a non-adjusting event has occurred and is going to impact on the going concern, then it becomes an adjusting event. Okay, so that's what you need to learn. Then we have two more things to learn. Okay, we have two more things to learn. Okay, so after the, is it two or one of them? Okay, so but before we learn that, yeah, we have two more things. Yeah, so that after we learn that two things, I will now ask you a question. Okay, you needed to answer me. Then we move away from IS10. So before we learn that, let's solve this question. So everything I've just said, you see them there. Okay, so let's look at this question. You have the solution with you, but don't check the solution first. So let's break down this question. So let me read the requirement. It said, advise whether the directors is correct. Okay, so what's the question about? It said, shortly after the reporting date, a major credit customer of a company went into liquidation because of heavy trading losses, and it is expected that little or none of the 12 debt owed by 12,005 debt will be recoverable. Okay, so this customer is owing us 12.5. So let me just break it down so that I can save time. Okay, so it's owing me 12.5. Okay, and because it has gone into heavy trading losses, we may not be able to recover. So the examiner said 10,000 of the debt relate to sales made prior to year end. Can you see? The sales was made. 10,000 relate to sales made prior to year end, and 2.5 relates to sales made in the first 2 days of the new financial year. Okay, can you see that? Now said in the 20X1 financial statement, the whole debt was written off. Okay, now look at here, look at what is happening here. So that's why you need to understand the concept around IS10. Okay, the customer is owing me 12.5. Okay, then the old debt were written off in 20X1 financial statement, whereas 10,000 actually relate to 20X1 shortly before the reporting period, the end of the reporting period. And 2.5 happens at the beginning, the sales happen at the beginning of the new year. That's 20X2. Okay, so what they did was to write off the whole 12.5 in 20X1 financial statement. The question is that treatment correct? Obviously, it's not correct. There is mismatch. Okay, there's mismatch because naturally they needed to report those transactions that relate to a particular accounting period. So it's not correct. Okay, so I move on. He now said, but one of the directors pointed out that liquidation is an event after the reporting date, that the debt should not have been written off, but be disclosed. Okay, but disclosure should be made as a way of note in the financial statement. And you now write off the debt in 20X2 financial statement. Is the director correct? Do you know what the director is saying? He said they should not have written it off in 20X1. They should just disclose, okay, and now write it off in 20X2. The director is not correct as well. Okay, so if you see this kind of scenario in an exam question, in fact, that raises issues around ethics. This is a classical example of ethical issues. If they really know actually, okay, what they are trying to do, okay, probably they are trying to, ensure that their profits will go up for that period. So what they are supposed to write off, they can delay it. So that's an ethical issue, okay? But here, that is not a disclosure. You don't disclose because this is an adjusting event. That 10,000 already existed at the balance sheet date. So what do? You go back to 20S1 financial statement and write it off. Then for 20S2, that's 2.5, you write it off in 20S2 financial statement. If you like, you can make a disclosure in 20S1 financial statement. That's it. So that's the answer. So you can break it up. You can read it up in your solution over there. Okay, so that is it. Now let me now teach you. Let me now mention two more things. Okay, then we solve the last question. Then we move away. Now listen up. Now, whenever you see a question on dividend, okay, dividend is the amount of money or the return that goes to the owners of a company, the shareholders. Okay, so they pay them dividend. So depending on the company's policy on dividend, they decide how to pay. So there's an issue around dividend. Okay, there's an issue around dividend. For example, if dividend it was proposed in November 2019, dividend was proposed in November 2019, but paid in January 2020. It was paid in January 2020. So the question is this: will I go back to last year's account and recognize liability Okay, does liability really, do I have a present obligation as at the year end? So that's the issue here. So listen up. Anytime you see question on dividend and it relates to IS 10, then you tell the examiner that dividend is a non-adjusting event. Okay, dividend is a non-adjusting event. If dividend was proposed before the year end or it was declared before the year end and paid after the year end, it is a non-adjusting event. Listen up again. If dividend was proposed after the year end and also paid after the year end, it is also a non-adjusting event. Do you know why? Dividend are accounted for on a cash basis. Okay. Dividend are accounted for on a cash basis in accordance with IS1 presentation of financial statement. So when dividend occur, you just recognize it straight up. Okay. So it doesn't represent a present obligation as at the balance sheet date if it was proposed before the year end and paid after the year end. And that is it. And that is it. So let me teach you the last thing that you needed to know. I ask my question, then we solve the last question, then we move away. So let me teach you the last thing. There are two problems with IS 10. So this can form a discussion paper. So that's why you needed to understand. There are two problems with IS 10. Number one is difficulties in identifying whether an event is actually an adjusting event or a non-adjusting event. Difficulties in identifying whether an event is an adjusting event. So in practice, it's quite difficult sometimes when some transaction occur after the year end and you don't really know whether they are adjusting event or a non-adjusting event. So in that case, the standard says take it as an adjusting event. Okay, so that's one problem, one of the problems with IS 10. The second problem with IS 10 is window dressing. Okay, second problem is window dressing. If IS 10 is not applied correctly, it can lead to window dressing. So what is window dressing? Window dressing is when you artificially improve your performance. Okay, you try to take action, deliberate action to improve your performance. For example, you deliberately overstate your asset, you deliberately increase your revenue. Okay, recognize transaction artificially that did not really occur. That's what we call window dressing. And natural window dressing is illegal and is unethical. In fact, it's a criminal offense. Okay, it's a criminal offense. So that's window dressing. And for example, towards the year end. Now, look at this 2020, for example. A lot of companies are struggling with revenue. Revenue is dwindling, it's coming down every time. So towards the year end, an entity that is under pressure to perform, the shareholders they are waiting for return. Towards the year end, an entity can decide to do what we call window dressing. What do? They can start to raise invoices for customers order that were not placed. Okay, orders were not placed from customers. They were raising artificial invoices because they know that once they credit revenue, what happens? Their profit figure will come on. Another way they can also window dress their accounts is to do what we call channel stuffing. What's the meaning of channel stuffing? They'll be supplying their customers with goods that they did not ask for. They will supply them. They'll just be sending it to them because even though they did not place an order, that's what we call channel stuffing. Okay. After the year end, they will now reverse those transactions. Okay. They will now reverse those transactions. So that's another problem. So if IS 10 is not recorded or is not applied correctly, it will lead to window dressing. That's why when external auditor comes, they perform a test that is called row backward test and row forward test. Okay, so if you're an external auditor here, you understand what I'm saying. Okay, so that's what happened. So let me now ask you a question. Then we solve this question before us. Then we move away from this standard. Let me ask you, is COVID-19 pandemic an adjusting event or a non-adjusting event? Around December 2019, we heard about COVID. Then in Nigeria, I think it came around February or March. Okay, so before financial statements are authorized for issue. So your company, or if you're in my shoes, or you have a scenario question in the exams, what will you tell the examiner? COVID-19 pandemic, is it an adjusting event or a non-adjusting event? Grab your key part. Sorry, you don't have key parts again. Start touching the screen of your device. Go to the chat room. So let me know, what's your idea? What do you understand? Is COVID-19 pandemic an adjusting event or a non-adjusting event? So I'm waiting for your responses. Then we solve this last question and we move away from IS 10. COVID-19, nobody's answering me. Are you sure you're writing this exam? Okay. I think I see a chat. So let me try and find out. Oh, somebody's saying is a non-adjusting event. Oh, okay. For 2019's account. Oh, that's fine. Okay. Olivia, that's Olubumi, thank you. Then Olivia is also saying non-adjusting event. Miss Henry is saying it's an adjusting event. Okay, Adeolu, okay, non-adjusting. Fatima, okay. Aramide, okay. It's also non-adjusting. Okay, thank you for your responses. Adenike is also saying non-adjusting event for power period. Okay, all right. Chris, non-adjusting. It started before the reporting date. That's Miss Henry. Okay, okay. Yeah, it started before the reporting date, but let's take it back to Nigeria. Okay, so we are looking into Nigerian case. So it happens around, let's say, February or March this year. Okay, and it's affecting companies. It's a non-adjusting event, but if you affect going concern, it will be an adjusting event. Okay, that's interesting. Okay, thank you very much, Olatune. Thank you, non-adjusting. Somebody saying it's relative. Oh wow. Okay, gifts, non-adjusting. Okay, thank you very much. Because of time, thank you so much. I appreciate. Now listen up, listen up. So let's find out the answer. Now, when it happened, the IASB, the SAT, that's the what's it called? International Accounting Standard Board, the what's it called? The standard setters, the SAT all over the world. They start in where's the head office now? Switzerland. Okay, and they agreed that COVID-19 should be taken as a non-adjusting event. That was the agreement. Okay, so they agreed that it should be taken as a non-adjusting event. But I beg to differ a little bit, okay? I beg to differ a little bit because IS10 also says, even though naturally, naturally COVID-19 is a non-adjusting event. However, we said IS10 says if a non-adjusting event will impact ongoing concern of an entity, then becomes an adjusting event. So what happens to entities that they declared so many profits in December 2019? Then COVID came around January, February this year, and by March, they are filed for liquidation. Okay, obviously because of the pandemic, they cannot continue in business, so they can never take it as a non-adjusting event. So it will be an adjusting event. So that's it. So if you understand properly, just put up your defense, your explanation in the exam. Okay, so make sure you are really making sense. So that's it. So thank you for your participation. So let's look at this last question, then we'll move on. Okay, now there's usually a lead time between the end of the entity's accounting year accounting year, and when financial statements are authorized for issue. When I see that statement, no other standard is calling me. This is IS10, okay, and approved and signed off by the directors. In between this period, there are two types of events according to IS10. He has even told me, okay, which may require consideration when preparing financial statements. Now the examiner says you are required to identify. Can you see? He said identify. So look at the requirement properly and do according to what the examiner is saying. He said identify. Tell the examiner adjusting event and non-adjusting event. He said explain. Can you see? He said explain. Then I will explain. Adjusting event are those events that provide further evidence of condition that existed at the balance sheet date. Then I can decide to give the examiner two examples. For example, the receipt of bankruptcy of a customer after the reporting period, discovery of error or fraud after the balance sheet date. That's it. Okay, I've done that. And I said, explain this event and state how they are treated in the financial statement. For an adjusting event, it will require the figures in the financial statement to be adjusted for. That's it. I will earn my full marks. Then I go to the second one, non-adjusting events. These are events that are indicative of conditions that arose after the end of the reporting period. For example, disposal of major subsidiary, sale of major assets. That is it. Fire got in my plant at the end. What's it called? After the reporting period. That's it. How is it treated? I tell the examiner that a non-adjusting event only require a disclosure as a way of note in the financial statement. For example, you talked about the nature of the event and the estimate of the financial effect. That is it. I earn my full marks. Then I move on. That's it. Then I move to the part B of that question. It said, Company A is indebted to Company B to the tune of 50 million. Okay. So Company A is owing Company B 50 million. The financial year end of Company B is 30th June 2014. The examiner is not putting this up for fun. He has reason why he's putting it up, because I've told you, date is very important. On 30th July 2014, Company B received a letter from a liquidator advising that company A has gone into insolvency. Can you see that? Just 1 month after the end of the reporting date. Then the letter revealed that company A ceased operation a month ago, and that company B is only likely to receive a dividend of 20 kobo for every naira owned by company A. So out of the 50 million, I can only get 20 kobo out of the 50 million for every naira. That's what he's saying. So what do? I convert back to naira, okay? 20 divided by 100, that's it. So it's giving 0.2 multiplied by 50. It will give me 10 million. So that means I can get 10 million. That's the meaning. So 40 million is gone. I need to write it up because receipt of information about the bankruptcy of a customer is an adjusting event. Okay. You now say this is a normal practice of company B, boss to approve audited financial statement 3 months after. I've told you anything outside the period between the end of the reporting period and when financial statements are authorized for issue are not within the reach of IS10. So I ask myself, when is the accounting period? June 2024 of 2014. Then when did this happen? It happens 1 month after. When did they authorize financial statement? 3 months after. So that's July, August, September. That's it. So this is IS10. Okay. So that's how to prove it. Then required. Explain how the above transaction should be treated. It's very straightforward. It's an adjusting event. So that money, that 40 million is required to be, written off in the financial statement. Okay, so that's what you're telling the examiner. Prepare journal entry, debit, bad debt, credits, receivables, being bad debt written off in respect of companies A indebtedness. That's it. You write the narration. Okay, you now say in requirement 3, state what would have been the treatment in the financial statement, assuming it was fire that destroyed company's B factory as at 30th July 2014. Of course, naturally, fire is a non-adjusting event. So I tell the examiner here that fire is a non-adjusting event. But if you are very clever and you are very good, then you put a caveat to it. However, if it will impact, even though we are not told that it's going to impact ongoing concern, but if it's going to impact ongoing concern, it becomes an adjusting event. That's it. That's it. Then you have your full marks, then you move on. Okay. Then, sorry, part C of that question. You said the directors of XYZ declare dividend. Once I see dividend, I don't need to waste time. No matter the story they are saying, they also tell the examiner straight up that dividend is a non-adjusting event because they are accounted for on a cash basis. That's it. So I don't need to waste time. So you can pick up your notes and read. Okay. So that's it. That's the end of IS10. If you have question for me, you can go ahead. Sorry, and ask your question. I'll be glad to answer. But if you don't have question, maybe at any time, at point in time you are reading, you have my number, so you can call or chat. I'll be glad to respond to you. Okay. So let's move on because of time. Let's take a look at agriculture. Okay. Agriculture. I'm believing God time will permit. I will introduce or we should be able to finish IS21. So that next class we're going to deal with IFRS 16, IFRS 2, and time permit we also take a look at IS19. Then there is a standard that you must know before you get into that exams. Okay, there is a standard you must know. IFRS 13, fair value measurement. So I'll take time, even if it's going to take us to have extra time. Okay, extra period. Okay, so just prepare your mind. Maybe on a Saturday night or Sunday night before your exams. So just prepare your mind, even if it's going to take us to have extra time. And we must take IFRS 15 and ratio analysis. I'm going to show you how to do your formula. You don't need to cram anything. But notwithstanding, continue with your study. So read ahead. You have the material with you. Read ahead of the class. By tomorrow, I'm going to try to send all the material, okay? So that you can start to read ahead. So when you come to class, it just be like a revision, like a refresher for you, and you are ready for your exams. So let's take a look at IS 41, agriculture, okay? I was about to deal with this last Sunday at the physical class, so I just explained the whole concept. So I'm going to deal with it now. When you hear the word agriculture, IS 41 is flashing you. Agriculture applies to two things, biological assets and of course agricultural produce. So just listen to me like I've said. Most of the things I say may not correspond with what you're having on your screen because I don't really like looking at the material when I lecture. Okay, so just bear with me. Okay, but when I need to solve questions, I will show you. Okay, so I can run the whole of IS 41 in 10 minutes, okay? And you understand. I'll break it down. So just listen to me, even though I may be a little bit fast, but if you listen to me carefully, the key thing you need to know, I'm repeating them over and over so that you can listen, okay? And so that you can understand. So all you need to do is just put me on loudspeaker and listen. And most likely, when you're in the exam hall, you will be remembering my echo, that will help you when you're answering those questions. Agriculture applies to biological assets and agricultural produce. It does not pass that. Biological assets and agricultural produce. The question now is this: what is biological assets? According to IS 41, a biological asset is a living plant or animal. Nobody's going to ask you this question, but you needed to understand. Sorry, you needed to understand so that you can solve question. Sorry, let me take a little bit of water. Okay, sorry. Yeah, so you needed to understand so that you can solve question. Now, a living plant, what does that mean? If I have a cassava, okay, it's a plant. I have a vegetation, that's also a plant. That's what I mean by once it's living, it's a biological asset. Then animal, I have a cockerel, I have goats, I have what they call it, cow, and all of that. I have fish pond. That's animal, living, plant, or animal. So that is a biological asset. What is agricultural produce? Agricultural produce is the harvested product of the entity's biological asset. Agricultural produce is the harvested product of the entity's biological asset. So if I go into my plant, implantation of my vegetable plant, and I pluck or I harvest my vegetables. What I harvest is the agricultural produce. If I go into my corn farm and I harvest corn, okay, or maize as it were. So those are agricultural produce. It's also possible that I have a cockerel that lays egg, okay. Okay, sorry, somebody's saying something here. Let me see. Okay, sorry. Somebody, sorry, somebody's trying to say something, is chatting me privately. Sorry. Okay, so let's move on. Sorry. Okay. 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 So now, so when I have a cockerel and the cockerel lays eggs, sorry about that, break. Okay, that is agricultural produce. Okay, that is agricultural produce. So what it means is, if a farmer buys a calf, that's a young calf. Okay, that calf is a biological asset because it's a living animal. So when the calf grows up, they will say it's passed through what we call biological transformation. And when it grows up, becomes a cow, and the farmer milks the cow. So they'll say that milk is agricultural produce. So when you hear IS 41, think about biological assets and of course agricultural produce. Okay. Now let's now pick it one by one. Accounting treatment. Okay, before I go to accounting treatment, let me talk about recognition criteria. Before you can recognize a biological asset, yeah, it's part of accounting treatment anyway. Okay. Now you can recognize a biological asset, three conditions must be met, even though I'm not really expecting the examiner to ask you that at this level. I'll tell you what they will ask, okay? So when we get there. Now, three conditions must be met. Number one, it must be probable that future economic benefits associated with the biological assets will flow to the entity. That's one. Future economic, just like your normal asset, okay? Probable that future economic benefits associated with that biological asset will flow to the entity. Number two, the cost or fair value of the asset, that's biological asset, can be measured with reliability. The cost of fair value can be measured reliably. Number three, the entity controls the asset. When those three conditions have been met, I can decide to recognize a biological asset. If two of them are met, I cannot recognize a biological asset. So those three conditions must be met. Okay, so those three conditions must be met. Then, what is now the accounting treatment? Listen up. On initial recognition, I'm still taking biological assets. On initial recognition, okay, biological assets are measured at fair value, less cost to sell. Can you see that? At fair value, less cost to sell. You need to bring that to your memory. Unlike other type of other assets under what's it called, IS 16, IS 40, where on initial measurement you measure PPE at cost model. Even investment property on initial recognition you measure at cost model. When you come to IS 41 agriculture, it is measured at fair value, less cost to sell. It is measured at fair value, less cost to sell. Now listen up. When I measure at fair value, less cost to sell, gain and loss will arise, okay? Or let me say gain or loss will arise, because both of them cannot arise at the same time. So gain and or losses is going to arise. So whenever I have gain or I have loss, I take it to profit or loss account. So when it comes to biological assets and I measure at fair value, less cost to sell, any gain or loss that arise on valuation at fair value, less cost to sell, I take it to profit or loss account. Listen up. Naturally, when you measure a biological asset at fair value, less cost to sell, it will always result into a loss. Do you know why? Because of the cost to sell. You have, removed it from the fair value, so it comes down. It comes down when you now compare with the fair value, so it will always be a loss. Okay, but you can actually have a gain. Probably, maybe your goat gives birth. Okay, maybe it gives birth and all of that. So maybe in that case or in that scenario, you can have a gain. Okay, so naturally, when a gain or loss arise on measurement of investment measurement of biological asset at fair value, less cost to sell, where do you take it to? Profit or loss account. Okay, you take it to profit or loss account. You need to know one more thing here. Number 2, subsequent measurement. Don't forget, initial measurement is I'm bringing on to my financial statement for a first time. Okay, I'm bringing it on to my financial statement for the very first time. Now, subsequent measurement. Listen up. Subsequent measurement. IS 41 says biological assets must be revalued to its fair value, less cost to sell. That's it. It must be revalued to its fair value, less cost to sell on subsequent measurement. So what it means is both initial measurement and subsequent measurement are the same. Measure it at fair value, less cost to sell, and value in use. And obviously, gain and loss can also arise. So when gain or loss arise on remeasurement, where do you take it to? Profit or loss account. So let's take a look at a question to demonstrate what I've just explained. Then we needed to now learn 2 more things. Agricultural produce, an asset outside the scope of IS 41, and that is the end. It's as simple as that, okay? That is the end. So let me find out. So everything I've said, they are here, okay? So that you can see them there. All right, so let's take a look at this question. Like I would say, you have the solution with you, but don't try to look at the solution. Okay, let's apply what I've just explained on this question. Let's see whether we are going to get it correctly. Now, it said, let me read the requirement first, so that I will just be solving the question as I'm reading. It said, discuss the accounting treatment of the above in the financial statement for the year ended. I've told you, 31st December 2021. So that date is very important. Now, and I've told you as well, if you are in my very first class, whenever you say accounting treatment, don't bother about recognition criteria. The guy is asking me at what value with this asset, as it were, is going to be recognized. So it's talking about measurement. Okay, so that's what comes to my memory. So I've told you, don't always expect the examiner to always say, according to this standard, according to that standard. If they say that, that's fine. It makes your job much easier. But how do I know which standard the examiner is testing here? Okay, so let's see the question. It said, on 1st January 2021, a farmer. Hey, when I see a farmer, which other standard we talk about a farmer? At IS 41. It's as simple as that. IS 41, because it's agriculture. Don't forget, I am not a farmer, right? So I may not be able to tell you some technical jargons that relate to agriculture, but obviously I know the accounting side, okay? So which is the standard, okay? So IS 41. So that's it. That's one. So when we get to some area and I cannot really go down to explain, so don't, because I didn't grow up in the farm. Okay, so let's move on. He said a farmer had a herd of 100 cows, all of which were 2 years old, at this date. Can you see that? At this date. It's still referring to 1st January 20X1. The fair value, less point to our cost to sell of the head of cow is 10,000. I don't need trouble here. The examiner already calculated it for me. He said the fair value, less point of sale cost of the head was 10,000 at the beginning of the year. I don't have issue here. Can you see that? I only have to revalue that subsequent measurement at the end of the year. That's it. So he has done my initial measurement for me. So I move on. You need to understand. Did you see that? Once you understand what you are doing, okay, you're fine. And now move on. You now said on 1st July 20X1, during the year, I'm still in that year. At the beginning, I have 10,000 cow already measured. So I don't trouble myself. You now said on 1st July 20X1, the farmer purchased, can you see, 20 cows, purchased. And we said, whenever you are measuring biological asset on initial recognition, you take it at fair value, less cost to sell. Did you see the point? The farmer purchased. Why is cow a biological asset? We said a biological asset is a living plant or animal. So cow obviously is a biological asset. Each 2.5 years old for 60 naira each. Okay, so that is it. So I need to initially measure 20 cows. So what is the fair value? It will be 20 multiplied by 60. Okay, 20 cows for 60 naira. So it will be 20 multiplied by 60. That will give me 1,200. If my brain is not failing me. So 20 multiplied by 60, that will be 1,200. That's it. That's the fair value. But I needed to revalue. Sorry, I needed to measure it at fair value, less cost to sell. So if my fair value is 1,002, then I will ask the question, where is the cost to sell? He said market auctioneers have charged 2% levy for many years. Okay, can you see here? Instead of the examiner to have told me that the cost to sell is 10 naira or is 20 naira, is giving me in relative terms. Can you see? It's giving me in relative. It just want me to perform a lot of arithmetic around here. So if cost to sell is 2%, I'll now say 2% of 1,2, okay, to give me the cost to sell. So if I say 2% of 1,2, that should be around 24. If I'm correct, it will be 24. So when I now say 24 minus 1,2, I will have 1,176, if I'm correct. I will have 1,176. So that is the fair value less cost to sell, 1,176. And the fair value is 1,2. So that means there is a loss. If I compare the fair value with fair value less cost to sell, 1,2, then 1,176, so there is a loss of 24. I take it straight away into my profit or loss account. But that's on initial measurement for the 20 cows. But the examiner wanted me to calculate as at 31st December 20X1. So when I come to the end of the year, IS 41 says you must revalue to fair value less cost to sell. So that means the cows I have at the beginning, can you remember, which is this 10,000? I have this 10,000 at the beginning. Then during the year, I purchased 20 cows, how much, which is 1,176. So the two of them is, that's 11,176. That's the total for what I have at the beginning of the year and what I purchased during the year. I will now revalue to its fair value. Then I will ask the question, how much are they selling cow at the end of the year? The examiner says, as at 31st December, 3-year-old cow sold for 90 naira. Can you see the point? 3-year-old cow sold for 90 naira. I have 100 cows at the beginning of the year. I purchased 20. At the end, I have 120. Did you see the point? I have 120. I will simply say 90 multiplied by 120 is going to give me a figure. That's it. It's going to give me a figure at the end of the year. Don't forget, less cost to sell. I will now multiply by 98% because this is 2% here, or if you like, calculate 2% on it and remove it. It's the same. It's going to give you the same answer. So I will have the value as at the end of the year. That's fair value less cost to sell. I will now compare with that 11,176, which if it's higher, then there's a loss I'm going to recognize. So let me show you that in your answer. Let me show you what I'm just explaining. I just try to break it down. Okay. So let me show you. Can you see now? Can you see? So this is how we have the 1,176. When you say 20 multiplied by 60, the new purchase in the year multiplied by 98%, you are very good in mathematics. You don't need to query this. But if you are not really good, just say 20 multiplied by 60, that will give you 1,2. Calculate 2% of that 1,2 to give you 24. Remove that 24 from 1,2 to give you 1,176. That's it. And if you are very good, just multiply 98%. So I recognize that 24 straight away into my statement of profit or loss account. So when I come to the end of the year, what happens? So if you calculate 90 naira, you're selling cows 90 naira at the end of the year. If you multiply by 120 cow, 100 at the beginning and the 20 that we purchase during the year, you get this figure. Multiply by 98%. Don't forget, you remove the fair value less cost to sell. So if you remember, this is the value at the beginning of the year. This is the new purchase. So if you add it together, that is 11,116. And this is the fair value less cost to sell because I must revalue to its fair value. So since this is lower, then I have a loss of 592 in my profit or loss account. That's it. That's it. So you take your time and take a look at that. Then you are fine. Okay. You take your time and take a look at that. Okay. Then you are fine. Okay. Please, how is 24 a loss? Okay, that's a question. How is 24 a loss? So let me show you how is it a loss. How much is the fair value? 1,200. Is that okay? 1,200 is the fair value. If you remember, so if you now remove that 1,200 from fair value less cost to sell, you're going to have 24. So you can perform that on your calculator. You can perform that. Please, where you credit the loss to, you debit because the loss to profit or loss account. Okay, you take it to profit or loss account. Okay, you take it to profit. You take it. What will be the corresponding entry? Okay, you debit profit or loss and credit the biological assets. As simple as that. Yeah. Okay. So Rabia, confirm you understand how we go 24 before I move on. Okay, thank you. Yeah, thank you, Adenike. Yeah. Rabiat, please confirm you understand how we get on 4. So let me do that again. When you say 20 multiplied by 60, that will give you 1, 2. That's a fair value. Then that's a fair value less cost to sell. Okay. So if you calculate 2% of this, you have 24 naturally. Okay. And if you remove that 24 from this, or if you remove 1176 from 1, 2, then you also have 24. So it depends on the way you are doing your calculation. Okay. So let me see. Okay, thank you very much, Rabia. Okay, so we are fine. Now we needed to learn 2 more things. Okay, so I'm glad time is still a little bit on our side because I needed to take you IS21. Okay, thank you. So we needed to learn 2 more things. Now listen up. 2 more things. So that's biological asset. Nothing is bigger than that. So that's biological asset. So let's now take a look at what's it called? Agricultural produce. Now listen up. Listen up. Listen. Like I said, I won't show the screen. So let me just try and explain. Because when I show the screen, I'll just be reading. So it will not make sense to you. So let me express myself by explaining so that you can understand. But you have the note with you. Okay. Now listen. Now, when it comes to agricultural produce, listen up. Listen up. At the point of harvest, okay? At the point of harvest. What does that mean? I go into my farm to pluck or to harvest my, what they call maize, corn, cassava, okay? Or I go into my farmyard. I wanted to harvest my fishes in the pond. I want to milk my cow. As 41 says, at the point of harvest, agricultural produce must be measured at fair value, less cost to sell. Okay, everything around IS41 is fair value, less cost to sell. That's just the shortcut to that. Okay, so IS41 says at the point of harvest. Okay, at the point of harvest, you must measure all your agricultural produce at fair value, less cost to sell. So it's also possible that there are gain and losses. Okay, so gain and loss, or losses rather, may arise. So you take it to profit or loss account. So gain or losses arise, you take it to profit or loss account. Now listen up. Now, after agricultural produce has been harvested, listen, after agricultural produce has been harvested, IS41 will cease to apply. Let me say that again. After agricultural produce has been harvested, IS41 will cease to apply. Okay? So, but don't forget that before harvest, I must measure at fair value, less cost to sell. After harvest has occurred, agricultural produce will cease to apply because it becomes an item of inventory. So IS2 will continue to apply, okay? So the initial measurement of agricultural produce will now be the deemed cost for the purpose of IS2. Okay. Okay, what I did now, I will do it again, but let me address this question. Please, how did we arrive at 592 loss? Okay, let me show you that. If you had 10,000 plus 1176, you will have 11,176. So that's higher than the fair value at the end of the year. So remove it. You will have this 592. That's it. So perform it on your calculator and confirm you understand. Okay? Because you have to revalue the fair value. You know, I've told you, you always have loss when you are doing agriculture. Okay, because of the fair value, cost to sell that you are removing. Okay. So that's it. Please confirm you understand before I explain. Before I continue, okay, I think I can continue while we wait for Rabia to tell us if she now understand what I said. Now, I'm on agricultural produce. So let me say that, let me do that again. One more time, a little bit faster. Now, we said at the point of harvest, okay, agricultural produce must be measured at fair value less cost to sell. Gain or loss are taken straight away to profit or loss account. After harvest, after agricultural produce has been harvested, okay, it becomes an item of inventory. Okay, what it means is IS 41 will stop to apply. Okay, so the initial measurement at the point of harvest becomes the deemed cost for the purpose of IS2. That's it. Check November 2019. The examiner said, in line with IS 41, explain the accounting treatment of agricultural produce. If you do that, what I just said, you can put it up in your exams, that's 5 marks. Okay, so that's it. So that's the first thing you needed to learn. So let's learn one more thing, and then we'll solve questions. One question, then that's the end of IS 41. Rabiat, I'm still waiting. I want you to confirm you understand 592. Okay. Otherwise, let me take it again. Okay. Okay. So let's learn one more thing around IS 41. Okay. Now listen up. Assets outside the scope of IS 41. There are 3 of them. What it means technically is this. When you are dealing with IS 41, it's possible you see some other standards coming on. For example, we've just seen IS2 inventory coming here. Okay. So there are 3 other standards, or let me say 3 other items, that also will feature in IS 41 question. Okay. All right. Thank you, Rabiat. I confirm you understand. Thank you. All right. Now, listen. Number 1 is production quotas. Okay. Production quotas. So naturally, production quota, you apply IS 38 to production quotas. So that's intangible assets. Okay. Intangible assets. So production quotas, you can't really see them, but it's a kind of document that contains agricultural information. Okay, so when you see a question around agriculture, for example, an examiner made mention of production quotas. In your explanation, just tell the examiner that you apply IS 38. Okay, so production quotas are measured at cost less accumulated amortization and accumulated impairment losses. Okay, so that's what you tell the examiner when it comes to production quotas that is featuring around IS 30, around the IS 41. But let me quickly tell you something. If a company is an agricultural company like IIT at Ibadan, at Ibadan, your state, now they have production quotas. Because production quotas, they are not recognized, okay? They are not recognized as an asset. Just like MTN. If you look at MTN, they have customers list. You can imagine they have over 2 billion subscribers. Is it 2 billion? That's a 2 billion. Okay, I'm not really too sure, but I'm sure they have well over 200 million subscribers. Okay, so now, and that looks like an asset to them. Okay, but they can't take it as an asset because it is internally generated. It is prohibited in accordance with IS 38. But if FCA should go and buy customers list from MTN, right? Because we want to sell an email blast, to students and all of that. Then FCA can take it as an intangible asset and amortize over the useful life or whatever, okay? Because it is a purchased intangibles. That's why when you are doing your group accounting, listen up, when you are doing your group accounting and you are measuring the fair value of the proportionate net asset acquired of the subsidiary, what happens to brand? You recognize brand because they purchase brand. That's it. That's it. But internally generated brand are not recognized as an intangible asset. That is not where I'm going. I'm just trying to bring your mind to it. Can you see now? So the same thing with production quotas. You don't recognize it, okay, when it's internally generated. But when a company goes there to purchase, then you can take it as an intangible asset. IS 38 will apply, okay? IS 38 will apply. IS 38 will apply. Okay, you don't really need to bother about production quotas, okay? If you want to know more about production quotas, you can, I'm not in a Greek, but like I said, it's a document that contains agricultural information, okay? A document that contains agricultural information. For example, we wanted to go into implantation. What are the kind of what's it called? What are the kind of products you can, or what are the kind of plants you can, plant in certain area, maybe in northern part of Nigeria, on certain soil and all of that. So those are the information you have around there. But obviously, nobody will bother you about that. Okay. Now, number 2 is Biara plants. Okay, Biara plants. Biara plants. That's number 2. Is Biara plants. So what happens? Biara plants are used to grow agricultural produce for more than 1 year. Listen up, Biara plants are used to grow agricultural produce for more than 1 year. For example, tea bushes. I've told you, I'm not a farmer, so I'm just trying to explain. For example, tea bushes. But in your exams, once the examiner says a grapevine is used to grow agricultural produce for 5 years, then you know that that grapevine is a Biara plant. Once you use it to grow agricultural produce for more than 1 year, can you see? That means that Biara plant can exist for more than 1 year. It could be 5 years, it could be 20 years, it could be 50 years, okay? Then know that that is a Biara plant. So Biara plants, for example, like tea bushes, are used to grow agricultural produce. So which standard will I apply? I will apply IS 16, property, plant, and equipment, okay? When you see a Biara plant, if you are able to identify a Biara plant in your exams, then you apply IS 16, property, plant, and equipment. Now listen up. Unharvested produce growing on a Biara plant, unharvested produce growing on a Biara plant, you apply IS 41. Don't forget, unharvested produce growing on a Biara plant, you apply IS 41. At the date of the harvest, you must measure at fair value, less cost to sell. After it has been harvested, IS 41 will cease to apply because it becomes an item of inventory. And from that time, IS2 will apply, okay? The initial measurement becomes the deemed cost for the purpose of IS2. That's what you need to learn. So when you see Biara plants, IS16 will apply. Then the last one is the land related to agricultural activity. Land related to agricultural activity. Land related to agricultural activity. Now listen, if a company has a land or building, earned for capital appreciation or to earn rental income, IS 40 will apply. Let me say that again. If an entity has a land or building or part of land or building or both held for capital appreciation, for example, you bought a land at the colonial area of Lagos State and you leave it there, hoping that in the next 10 years, the value will go up. That's what we call capital appreciation. Or you rented it out and you are earning rental income, that is what we call, you apply IS 40 investment property. But when you use a land, listen up, for agricultural activity, that's what we call land related to agricultural activity. You use the land for your fish pond, for example. You use land to plant your maize and all of that. That land is related to agricultural activity. You apply IS 16, okay? You apply IS 16. So when you see land, don't say this question is not correct. It's supposed to apply to IS 40. No, you apply IS 16. And don't forget, under IS 16, on initial measurement, you use cost model. On subsequent measurement, You either use cost model or revaluation model. When you revalue upward under IAS 16, you take it to other comprehensive income. When you revalue downward, you take it to profit or loss account. When I'm dealing with IAS 40, when I revalue upward, that's under fair value model, I take it to profit or loss account. When I revalue downward, I also take it to profit or loss account. We are not really dealing with those standards, but because they are related to what I'm doing here, that's why I just have to jump into them, okay? So that's what you need to understand. So when I see land related to agricultural produce, I will apply IAS 16. And that is it. That's the end of IAS 41. If you have questions, you can put it up there, but we have a question before for us to solve. Everything I just said is over there. So let's solve this question and we move away so we can start IAS 21. Okay, good wine. Let me just look at the requirements. Don't look at your answer like I will say. So what I've just explained, let's see whether we can apply it on this question. It said, discuss the accounting treatment of the above in the financial statement of good wine for year ended 30th June. So I'm interested in 30th June 20x2. Can you see that? This is what I'm interested in. And he has already told me that I should discuss the accounting treatment. That is value. You want me to calculate. That's it. Okay. So let's move to the question. I know what to do. Okay. It said, Good Wine is a company that grows and harvests grapes. Can you see that? When I see this, I don't need a soothsayer in the exam hall to tell me that this is IAS 41. Okay. Grapevines. Can you see? It said grapevines which produce new harvests of grapes each year are typically replaced every 30 years. What is that? This is a biara plant. If you have listened to me very well, we said a biara plant are used. Biara plants are used to grow agricultural produce, okay? Biara plants are used to grow agricultural produce. Somebody is saying something here. Please, which standard applies to unharvested produce growing on a biara plant? Obviously, that's IAS 41. I didn't care as answer. That's it. That's IAS 41. Thank you. Okay, so let's move on. So when I see grapevines, said the grapevines which produce new harvest of grapes each year are replaced every 30 years. That means it's more than one accounting period. Can you see that? So this is a biara plant. And I recall in my memory that whenever I say biara plant, I apply IAS 16. So the examiner did not tell me here that this is a biara plant. But because I know already that biara plants are used to grow agricultural produce for more than 1 year, I move on. He said, harvested grapes are sold to wine producers. Oh, that's fine. But this will not influence my calculation. I move on again. He said, with regards to property, plant, and equipment, with good wine account for land. Can you see? It's talking about PPE now. He now said they account for land using revaluation model. Can you see? So if I see land in the question, I need to apply revaluation model, provided the land relates to agricultural activity. Can you see now? So that's why you need to understand. And all other classes of assets, they use cost model. Don't forget that biara plant, I will also apply IAS 16. So since all other classes of assets, biara plant is going to fall under that, I will apply IAS 16 cost model. Can you see? Then I move on. He said on 38 June 20x1, that is the beginning of the accounting period. I have peeped on my requirements. The examiner says I should calculate up to June 20x2, 20x1. Sorry, is it 20x2? It should be 20x2. Yeah, because this is media accounting. Yeah, June 20x2. Can you see? That's the end of the accounting. That's the following year. Okay, because this is the start of the accounting. So that's it. So just 1 year after. That's it. It said its grapevines had a kind amount of 300 with a remaining useful life of 20 years. So what do I do to a grapevines? I've already known that grapevine is a biara plant from this question. So, and he said all other classes of assets are carried out cost model. And I've told you, whenever you want to get a kind amount of an asset, what do? You look at the cost or the kind amount minus accumulated depreciation and accumulated impairment losses. How do I get my depreciation here? I simply say 300 divided by 20 years. That's it. If you remember, 300,000 divided by 20 is going to give me 15. And I'm calculating depreciation for only 1 year. I'll say 15 minus 300,000 minus 15, it will give me 285. So as at 30th June 20x2, the kind amount of grapevine will be 285. I have dealt with that. That's what I'm telling the examiner. Then I move on. The grapes on the vine which are generally harvested every year at a fair value of 500. Can you see? That is a grape growing on the vine. They have a fair value. Don't forget, we are still at 30th June 2021 at the beginning of the year. So the fair value is 500. It now says the land used for growing grapes, used for growing the grapes vine at a fair value of 2 million. Can you see now? So that's at the beginning. What now happened at the end of the year, which the examiner really wants me to calculate? He now said grapevines with fair value of 100 were harvested. Can you see? Due to unusual weather condition. So how do I do this 100? Can you remember? Okay. Don't worry, the light will be restored very shortly. The light will be restored shortly. Okay. Okay. So how do I do this? Don't forget that at the point of harvest, okay, at the point of harvest, agricultural produce must be measured to its at fair value, less cost to sell. Okay, that's it. It has to be measured at fair value. So this is a fair value. Okay, and gain and loss are taken to where a profit or loss account. So obviously this is a gain. So you take it straight away to profit or loss. But they were harvested. So now IS 41 will cease to apply. So this 100 will now become the deemed cost for the purpose of IS2. That's what is happening here. He now said the grapes left on the grapevine had a fair value of 520. Can you see? The grapes that left had a fair value of 520, and at the beginning of the year it was 500,000. What happened? So that's a revaluation gain. I take that 20,000 into my what they call it, into my profit or loss account. Okay. He now said the land had a fair value of 2.1 million. I asked the examiner, how do you want me to treat land relating to agricultural activity? He said it's carried under revaluation model. That's it. So I will have to revalue from this 2 million. Can you see? I revalue from 2 million, I revalue to 2.1 million. So when I revalue upward under a 16, where do I take the 1 million, 0.1 million to? That's 100,000. I take it straight away to other comprehensive income. And that's the end of the question. That's the end of the question. He said selling costs are negligible. That's why you're having that gain. Okay. He said they are negligible. If you are not negligible, obviously it's going to be a loss. Okay, so that's it. So you can check the solution and confirm with what I've just said. Okay, so obviously you are playing around 3 to 4 standards here: IS 41, IS 38, IS 2, and IS 16. That's it when you are dealing with a question on agriculture. And that's the end of the standard. That's the end. That's the end. If you have a question for me, you can put it up there. So you have the solution there. At your time, you take a look at it. Then you have a practice question as well. So we have this to deal with. IS 21, the effect of foreign exchange rate. The effect of foreign exchange rate. Let me give you about a few seconds. If you have question on agriculture, even IS 10 that we've just done, can you please ask a question? Okay, ask a question. So let's deal with this standard. Let's deal with this standard. I think we have about, let's say 40 minutes. Let's see whether we can finish up. I'll be so glad if we can finish IS 21. And the next time we know we are starting with leases, okay? We are starting with leases. IS 21, I think, let me check the chat room. The chat room is quite, okay, so no question for me. All right, that's lovely, that's fine. So it means we are following. Now, most likely, we are getting my explanation. Okay, so I want to believe. I want to believe. I want to believe. Okay. Okay, so let's deal with IS 21. Since there won't be questions, I think that's something I dropped on the chat button. Okay. It's clear. Okay, thank you very much for thank you for the affirmation. You know when the chat room is silent, it's a little bit confusing because sometimes I wouldn't know whether you're laughing for me or you're laughing on me or you're laughing against me. So I wouldn't know, but your comment will let me know whether you're actually following. Okay, so thank you, Mr. Kichuku. Thank you. Okay, now let's deal with IS 21. Now listen up, listen. Okay, let me start like this. Whenever a company engages in a transaction, or let's say, engages in a transaction in a currency other than the national currency, IS 21 will apply. Let me say that again. If your company buys or sells in a currency other than Nigeria's naira, IS 21 will apply. So if a company is located in Nigeria, naturally, my national currency is naira, for example. So I decide to buy in dollars or pound sterling or Japanese yen, or I bought from a German supplier which invoiced me in euros. Okay, IS 21 will apply. So effectively, IS 21 deals with three things. Number one, the definition of functional and presentation currencies. Two, accounting for individual transactions in foreign currency. And of course, three, translating the financial statement of a foreign operations. So for the purpose of this class, we're going to deal with the first two, okay? We're going to deal with the first two. So my other guy, if time permits, is going to take you on foreign subsidiary, okay? So that in your group accounting. So that's the third one. So, but your knowledge around that is 21 here is going to really help you when you get to your foreign subsidiary. And I think I was going to work about 2 or 3 days ago, and okay, sorry, it will be yesterday, not 3 days ago. Today is still Tuesday. Okay, so and something occurred to me that the examiner might decide to go to foreign subsidiary as your compulsory question. That's the way I was thinking, because it's been a while that it was treated, it was tested as May 2017, if I can recall. Okay, so you might need to take a look at that. Okay, so it's quite very straightforward. The issue here is just conversion. Okay, so that's it. So that's what I think. But I'm not saying that's what will come out. So I'm just thinking. Okay, now, so let's take a look. What is a functional currency? And of course, what is presentation currency? Functional currency is a currency of the primary economic environment in which an entity operates. Okay, the currency of the primary economic environment in which an entity operates. So that's what we call functional currency. Presentation currency is a currency in which financial statements are presented. Okay, that's presentation currency in which financial statements are presented. So naturally, when I do conversion, there's something we call exchange difference. Okay, because of the unit of one currency to another are not usually the same, so you always have exchange differences. Okay, so for example, you see, I think $1, or let's say maybe 400 naira is equal to $1. Okay, so if you do translation, you have more depending on the currency you are translating from. Okay, so obviously, when you translate, it will always result into exchange difference because of fluctuations in exchange rates. Okay, so that's it. Now, according to IS 21, when an entity is determining its functional currency, they must take into account three primary factors. Okay, the examiner can give you a scenario, okay, and in the requirement it says what are the factors that the entity will consider in determining their functional currency. In another scenario, in another case, it can give you another scenario, and the requirement is say what is the functional currency of that company. So you need to understand. You needed to understand these three economic factors, or let me say three primary factors that an entity must consider. Number one, the currency that mainly influences the sale of goods and the sales price for goods and services. Okay, the currency that mainly influences. Can you see that? Is there? Is there? The currency that mainly influences the sales price of goods and services. So you need to determine which currency. For example, if you come to Nigeria, of course, Naira influences the sales price of goods and services. Number two, the currency of the country whose competitive forces and regulations mainly influences the sale price of goods and services. Can you say that? The currency of a country whose competitive forces, when you say competitive forces, what does that mean? The forces of demand and supply and regulation, like CBN rules and all of that, mainly determine the sales price of goods and services. So when you see all of these, then you can say this is what's it called? Functional currency. And the last one is a currency that mainly influences labor, material, and other cost of production. Okay, can you see that? That's it. Currency that mainly influences labor, material, and other cost of production or cost of producing goods and services. So those three primary factors needed to be considered before an entity can determine its functional currency. As 21 was quick to say, if you after applying the primary factors and an entity cannot still determine its functional currency, then it should apply two secondary factors. Okay, you should apply two secondary factors. So these secondary factors are the currency in which form from financing activities are generated. Okay, the currency in which funds from financing activities are generated, and the currency in which receipts from operating activities are retained. The currency in which receipts from operating activities are retained. That's it. That's it. That's it. Now, IS21 also mentioned something. He said there are times that when a foreign subsidiary, rather than applying those rules, that's the primary factors and the secondary factor, they will just go ahead and use the same functional currency of that of its parent. But in doing that, they must consider the following factors. Okay, so this is just a matter of something you can just try and put in your head in case you needed to explain up to this level. Whether the foreign operation operates as an extension of parent, the level of transaction with the parent, whether cash flows are readily available, and of course, whether the foreign operation has sufficient cash flows. So those are the things they need to consider if they can go ahead and just use the functional currency the same as the parent. Okay, so that's it. So that's it. We have ticked number one that IS21 is dealing with. Can you see? It's very straightforward. So let's take a look at this question. Like I will say, the answer is there, but don't look at the answer. So let's try to apply what we have just learned. It said, what is the functional currency of chive? Is it chive or chief? Okay, chief or chive, just pick one. It's an entity located in a country rather, sorry, whose currency is in dollars. So the fact that I'm located in a country whose currency is the dollar does not necessarily mean that is my functional currency. I needed to apply primary factor. If the primary factor are not sufficient, then I consider secondary factor. He said 70% of child sales are dominated in dollar. Okay, 70% of child sales. Can you see? The currency that mainly influences sales of goods and services, can you see, is in dollar. So I can say, oh, the dollar is the functional currency. But I can assume, I need to read on. It said 30% are denominated in sterling. Can you see? So 70%, even though 70% is higher than 30%, because we say currency that mainly influences sales of goods. Then I read on again. It said child does not convert receipt from customer into other currency. Child buys most of its inventory and pays large proportion, in sterling. Can you see that? They buy most of its inventory, and pays in sterling. Can you see the currency that mainly influences other factors of production? Can you see that? So this is sterling. So I'm already having a dollar that influences sales price. I'm also having sterling that influences, cost of production. So primary factor is not sufficient for me to determine what is the functional currency. Then I move to the secondary factor. Okay, then I recall in my memory. Now, under my secondary factor, these are the currency in which funds from financial activities, are generated. Okay, and the currency in which funds or received from operating activities are retained. So, he now said, Chive has 2 bank loans outstanding. Both of these loans are denominated in dollars. Can you see that? Can you see that? That's financing activity is in dollars. So obviously, dollar is what was it called? Dollar is what? Is a functional currency. So that's it. Dollar is my functional currency. So you can look at the answers there. If what I've said is not in line with the answer, put it up on the chart. But obviously, it will be the same because I just apply the principle. Okay. So when you apply the principle, you don't need to entertain any fear because obviously you are doing the right thing. So let's now go to the last aspect. There are two more things that we need to learn under IAS 21. Then we say bye-bye. Okay, so let's see whether we can do that before the close of the lecture. Accounting for individual transactions denominated in foreign currency. You know, I told you earlier that whenever a company engages in transaction in a currency other than its functional currency, then IAS 21 will apply. Now listen up. When an entity enters into a transaction other than its functional currency, that transaction must be translated to functional currency. What I've just said, you have to put it in your head, because when you are explaining to the examiner, that's what you say, okay? Whenever an entity enters into a transaction denominated in a currency other than the home currency, that's my functional currency, that transaction must be translated to my functional currency before it is recorded. And in doing that, initially, I will use the spot exchange rate at the date of the transaction. So if I buy goods on November 17, 2020, at the date of the transaction in a currency other than my functional currency, or I will supply goods, okay, that means I buy, or I sold goods in a currency other than my functional currency, okay, I must translate into my functional currency using the spot exchange rate at the date of the transaction. IAS 21 also says you can also use average rate over a period of time, provided the exchange rate has not fluctuated significantly. I think in 2019, the exchange rate in Nigeria, the naira to the dollar was relatively stable. So in that regard, you can decide to use average rate. And some companies have even already predetermined the exchange rate they want to use, probably because they have entered into 4 contracts and all of that. Okay, so that's that. But obviously, average rate, usually applies to interest, because interest is paid over a period of time. So you use spot, use average rate for interest, because you pay it over a period of time. Now, listen up. Cash settlement. Cash, don't forget, what we have dealt with is at the date of the transaction. For example, I bought goods on May 5, 2020. Okay, I must translate to functional currency at that date. Then I paid at a later date, let's say April 1st, 2020. That's what we call cash settlement. IAS 21 says when cash settlement occur, okay, for example, I paid or I received cash from a overseas credit customer, okay, I must also retranslate to my functional currency using the spot exchange rate on the settlement date. So that's why when you see questions on IAS 21, you see different dates for different exchange rates. If you don't understand what I'm saying, you cannot solve that question. There are no two ways to it. You know, I will always say, even at the physical class, I will always tell them, this is accounting standards. If you don't understand, you can't. You approach those questions based on the principles, just like your SFN. Okay, if you're taking SFN, it's the same. It's the principles. Don't allow the question to dictate to you. You dictate to the question because you know what you are doing. Remember, at the date of the transaction, I must use the spot exchange rate to translate to functional currency. When cash settlement occur, I must also use the spot exchange rate to convert to my local currency. And in doing that, that is what we call exchange difference, because the is either my rate has fluctuated, has appreciated, or it has gone down. It has, it has been devalued, depreciated. Okay, so in that case, we have what we call exchange difference. And according to IAS 21, whenever an exchange loss or gain arise as a result of retranslation, you take it straight away to your profit or loss account. Now, even though it doesn't really involve movement of cash, but what the standard setters are trying to do here is that the effect, that's why they call it the effect of foreign exchange differences, changes, should be known, okay? The impact should be known or should be recognized on the financial performance. That's it. That's the whole idea, because it doesn't really involve movement of cash, but because of fluctuations. Look at the inflation rate, for example, in Nigeria, that's rising almost every day. So that if it's eroding value of money, profit figures, and all of that. So those are the concerns around that. Okay. Now, so I've explained exchange difference, take it straight away to profit or loss. So let's now take a look at this question, illustration, okay? To let's see whether what we have learned we can put it into practice. He said on 7th May 2006, an entity with a functional currency of dollars sold goods to a German supplier, okay, for 48,000 euros. He said an entity with functional currency of dollar. You don't need a soothsayer to tell you that this is IS21. Okay, on this date, the rate of exchange is $1 to 30 to 3.2 euros. Okay, now listen. I have to translate at the date of the transaction using the spot exchange rate. Now listen up. Students also have a problem or challenges around when do I multiply and when do I divide. Now listen. The first thing I need to recognize is this. What is my functional currency? The examiner says it is dollars. Okay, my functional currency is in dollars and I'm buying in a German currency. Okay, sorry, I'm selling rather. Okay, I'm selling in a German currency, that's euros. Then I ask myself, between dollar and euro, which one is strong? Which one is the strongest or strong? Which one is stronger? How do I know? I will now look at the way they have quoted this. Now here, don't think about direct quote or indirect quote, okay? Just disregard. This is not your hedging under your SFN. Okay, naturally this is a direct quote. If they put the foreign currency the other way around, that means the foreign currency they put it first, then they say it's indirect quote. But we are not dealing with that here. Okay, when you get to your SFN, you learn that. But what I want to do here is when do I divide? When do I multiply? Let me try to explain in my own little way. You can decide, you can learn, you can devise a means on your own how you know, okay? But let me try to explain. So when I know that dollar is my own functional currency and I sold goods in a foreign currency, in this case, euro, okay? Then how will I know whether I need to divide or not? I need to look at the way it has been quoted here. This is $1 to 3.2 euros. What does this mean? It simply means dollar is stronger than euros, okay? Dollar is stronger than euro. Why? For every $1, we have 3.2 euros, which is small. That means it's strong, is weak. That's the meaning. Just think of Nigerian naira and dollars, okay? If I have $5,000, for example, I want to take it into naira, I want to convert it into naira, I have to multiply because dollar is stronger than naira, okay? If I have 500,000 naira, which is weaker, I have 500,000 naira, and I want to convert to a stronger currency, I will divide, okay? 500,000 naira cannot give me $1 million. It's not possible because it's weak. So I have to divide. So when I look at this, okay, euro is stronger. Sorry, it's weaker. Okay, my dollar is stronger than my euro. And the goods I sold was sold in a weaker currency. Can you see the point? It was sold in a weaker currency. And I needed to translate to my stronger currency. I will have to divide. That's it. I'll just say 48,000 euro divided by 3.2 euros. It will give me in dollars. That's how they got this $15,000. Can you see? So you debit your receivables and you credit your revenue. Okay, because I sold on credit. Okay, so I want to believe you understand that. Okay, I have a question here. Sometimes the examiner includes average rate and rate at the balance sheet date. What do you do? I'm coming there. We are just starting, my brother. We are not done. Don't worry, you get everything. But I've mentioned something earlier. If you listen, I said when you see average rate, you apply it most times to what's it called? Interest. Okay, when you're paying interest on loan, you apply average rate. So when you see spot rate on all this we are doing, you apply spot rate. When it comes to balance sheet, I'm coming there. I don't want to mix things up for you guys. So that's why I'm taking it one after the other because a lot of people here are taking CR for the first time. They've never had lecture on IS21 because it's never done in financial reporting. So I'm coming, okay? I'm building you to a place. If you notice, I was a little bit slow. Even if you can't cover IS21 today, that's not a problem because I wanted to understand. Although I will try that we cover. So I will come to balance sheet date. And average rate is also used when you are doing your, what's it called? your foreign subsidiary. You apply average rate on what's it called? Statement of income. What's it called now? Profit or loss account. Okay, to translate. That's it. So, but I'm coming there. Okay. So let me build you up. So here you debit receivables, and of course you credit your revenue. That is at the date of the transaction. You use the spot exchange rate. Okay. Now, it now said on July 20x6, can you see? I bought in May. You remember? Now the customer paid outstanding balance. That means he paid everything. The exchange rate now was now $1 to 3.17. Can you see? The exchange rate was now $1 to 3.17. What happened? According to IS 21, I must retranslate to my functional currency using the spot exchange rate. So what do? I have to retranslate again. I will now say that 48,000, that is the value. I will now divide by 3.17. So I have 15,142. Don't forget, I said whenever you retranslate, it's either you have a loss or you have a gain. So how will I know? Let me teach you a technique on how to know. I'm expecting this guy to pay me $15,000. Can you see? That's my receivables. At the date of the transaction, at the settlement date, when the guy eventually paid, okay, when I converted, it was 15,142. Is that a gain or loss? I had additional money. Okay, so this is a gain. I will take it straight away into my profit or loss account. So it's not a debit because again, so I credit profit or loss and I credit my receivables because I've already debited it already and money is coming in. So I debit my cash. That's it. That's it. So when you are doing this, you must pass what's it called? Double entry. You must pass it when you are doing this. Okay. So the 142 will be credited to profit or loss account. So I want to believe you understand that. So don't forget, at the date of the transaction, I must translate to my functional currency at the cash settlement date. I must also retranslate to my functional currency using the spot exchange rate. So let's now go to year-end balance. You need to be with me here. That was a question my guy was asking me, Mr. Henry. Yeah, that was it. So if you understand that, let me now explain what happened at the end of the year. Okay, what happened at the end? What happens at the end of the year? That's the balance sheet date. Now listen up, listen up, listen. I want you to listen. You need to get. If you get this, that is the end of IS 21. The other thing you need to learn is your foreign subsidiary. That's it. Okay, so just listen to me. I'm going to give you, like I said, I won't look at, I'll just explain. Everything I'm saying is in your screen over there, is your notes, okay? Now listen up. Now let me go back to that illustration that we did earlier, okay? That we sold to a German supplier, okay, on credit, okay? So it's, let's say 48,000 euros, we converted to 15,000, for example, dollars, okay? Now, when the guy was paying, he did not pay complete money. He paid part of the payment during the year, okay? So since he paid part of the payment, I must also retranslate to my functional currency and pass relevant journal entry. At the year end, there is a balance because the guy has not completed the money. In the scenario we had, the guy completed the money. So at the year end, I don't have issues. But in this scenario, the guy has not paid completed money, okay? Or whether it might also be that I also buy on credit and I have not paid. I have not completed the money during the year. In fact, I may not pay at all, or I pay part. Once I pay part, I must retranslate. Then what that happens, if I have a year end, if I have a balance at the year end, that's what we call treatment of year end balances. Now listen up. At the year end, I must ask myself, is it a monetary item or a non-monetary item? Listen to me. I need to ask when I'm preparing my financial statement for all outstanding balances at the year end in foreign transactions. Are they monetary item or a non-monetary item? Listen, what is the monetary item? For example, cash, payables, receivables, or loan. That is a monetary item. If that transaction relates to cash or it relates to payables or receivables or loan, that is a monetary item, okay? According to IS, what do they call it, 21, I must retranslate using the year-end rate. Let me deal with this question before I continue. Please, sir, why did we credit 15,000 to Naira to revenue when cash was not received? Okay, that was a very brilliant question. You know, not all revenue are in cash. Okay, not all revenue are in cash. That's why the part of revenue you have, they are both cash and credit sales. Okay, so once you have credit sales, you take it to receivables, debit receivables, credit cash. So that's why when you are doing your ratio analysis and you are calculating your working capital, otherwise known as cash operating cycle, and you are calculating your receivable collection period, what's your formula? Average receivables. That's your trade receivables over credit sales. Okay. If the examiner did not give you credit sales, then you just take the whole revenue. In some exams, the examiner will say 30% of the revenue are credit. So in that case, you calculate 30%. That's it. So what you have in the revenue figure of most companies, they are not all cash. That's why, in fact, I even like this question. Don't worry, when we get to ratios, I will go more deeper into issues around accounting. Okay, so that's why accounting profit is not the same thing as cash. Okay, accounting profit is not the same thing as cash. That's why you see a lot of companies declare $2.5 billion in December 2019. COVID-19 happened, and in 3 months they can no longer operate. So why is it 2.5 billion that was declared in 2019? That's to tell you that because of the issues around window dressing, okay, and the issue around that, most of that revenue might be cash sales. They've not collected the money. Go back and look at their receivables. You see that it's very high. So that's the issue. So not all revenue are cash sales. Don't worry, when you get there, you understand better. Okay, that's it. Thank you. Now, so you ask yourself, is it a monetary item? If it is a monetary item, what do? You must retranslate using the balance sheet spot rate, balance sheet exchange rate. That's they call it year-end exchange rate. That's what Mr. Henry was asking the other time. That is if it is a monetary item. So you ask yourself, is it cash, payables, receivables, or loan? Okay. If it is a non-monetary item, listen up. If it is a non-monetary item, for example, my non-current asset, that's PPE, my inventory or my investment, they are non-monetary items. As 21 says, you don't retranslate. You will leave it like that, okay? You don't retranslate. So don't forget that you would have translated at the date of the transaction. But when it comes to the year end, you not paid the money. You are still owing, or they are owing you. When it relates to inventory, non-current asset like your PPE or investment, you don't retranslate. However, listen, however, if PPE is carried under fair value model, as 21 says, you have to retranslate at the date the fair value was determined. If PPE is carried at fair value, that's revaluation model, you have to revalue, really, okay, and you must retranslate at the date the fair value was determined. That means if PPE is carried at cost, you don't retranslate. That's it. That's it. That's it. That's actually one for you. That's it. That's it. And that's the end. So we can solve 1 or 2 questions and we say bye-bye. So everything I just explained, can you see? Retranslate using year-end exchange rate. That's it. Closing rate. So do not retranslate when it comes here. But if an item is carried on a fair value, can you see? Fair value should be translated date it was done. That's why if you see under your OCI, other comprehensive income, you will see exchange difference as a result of IAS 21. That's it. Because if you have PP, OCI, it goes to valuation increase goes to OCI. That's why you see that. Okay. So let's now look at this question on monetary item. I've explained it. So let's just look at this question. So the same question, I can remember you understand we got this $15. Okay. Somebody is saying, please let the recorder video be available tomorrow. Of course, it's always available the next day. Yeah, you don't need to beg us for that. We know you guys are reading. So the question is just, if the network was favorable, we are able to download it on time, also upload it for you guys to have it. So we'll try. You always have it. We know you are reading and you need it. So you don't need to beg us. It's your right, okay? So don't worry, you're having it. So we'll try to get it across to you as early as we can. Okay, thank you. Okay, Mr. Henry, thank you. It's clear now. Okay, thank you. I love that. Then Rabia, do you now understand why revenue, why we are crediting revenue? Okay, so let me see your feedback. So let me quickly explain this. Then we say bye-bye to IS21. So you have other notes. Please take your time and look at it, okay? So you understand how we got this 15, if you remember the past illustration. He now said, by the reporting date, July 20x6, okay? By the reporting date. Okay, thank you, Rabia. The invoice had not been settled. Can you see? By the end of the year, they have not settled the invoice. Then I ask myself, is this a monetary item or a non-monetary item? We know we say monetary item are cash, receivables, payables, and loan. Then this is receivable. So it's a monetary item. And according to IS21, I must retranslate using the closing exchange rate. So on this date, the rate of exchange. Can you see? The examiner will never tell you that this is a closing exchange. You just put date, 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 date. Sometimes they can say closing rate anyway. Sometimes they can say average rate and lot of spot rate. So they are just trying to help you. But in most cases, they will put date. It's not for you to look at the question, when is the date of the transaction, when is the settlement date, and of course, when is the closing year end. So because receivables are monetary item, it has to be retranslated. So what do? I will divide again. So when I divide, I have exchange loss, okay? Because when I divide now, I have 14118. Meanwhile, I was expecting $15,000. So the difference there is exchange loss. So I take it straight away to my P or L account. So when I come to non-monetary item, so let's find out. He said Olympic, which has a functional currency presentation currency in dollars. Okay, that's functional currency and presentation currency. Sorry, in dollars. Okay, account for land using cost model. So when I see that, since it's cost model, even though it's a non-monetary item, I will not retranslate. Okay, so now said on 1st July 20x5, Olympic purchased a plot of land in another country for 1.2 million dinars in another country. Then I'll ask, how did they quote? They quote dinars to $1. This is 4. Can you see? So that means my dollar, which is a functional currency, is stronger. So I will have to divide this 1.2 on the date of the transaction, which is 1st July. So this 1st July, can you see? I will just break it up. So 1.2 divided by 4. That's it. Okay. So to give me, is that 300,000? Yeah, that's it. So that's 300,000. So I take it at 300,000. I have not paid. Okay. Then at the year end, I will not retranslate because it is carried under cost. Naturally, you don't retranslate monetary item. But if it is now carried at fair value, don't forget, you have to retranslate at the date the fair value was determined. So they said, and they now said at 38 June, the fair value of the plot of land was 1.5. Can you see? So I will have to now retranslate using the exchange rate on that date, which is 3. So when I now say 1.5 divided by 3, can you see? I will have 500,000. When I retranslate it on the date of transaction, it was 300,000. So I revalue, it's now 500,000. So that difference of 200,000, where do I take it to? I take it to revaluation gain in the OCI. Everything I've said is what we are coming across now. So I already explained. So you have this exercise, you can practice it on your own. I think you should, okay, there's a solution there. Let me find out. Yeah, you have the solution there to guide you. So solve it first, okay, and that is the end of IS21. What if the land is subsequently recognized at cost? Do we? No. You continue to take it at cost, okay? You don't retranslate. Yeah, it's only when it's carried under fair value or evaluation model, okay? That's when you translate. Okay, thank you, Denike. So I hope you got that. Okay, all right, thank you. So any question for me? There's no questions. I'm so happy we're able to deal with IS21. So next class, I'll go straight away to leases. Okay, you have it. Let me find out. Let me find out before we close the class. You have it in your notes. Yeah, leases is here. So take a look at it, okay, before the next class, so that when I explain, you are just getting. Leases was actually tested last diet, but the examiner tested how to account for sublease. I think I have a question around that here. Okay, so we don't really know what they will bring around here if they want to test it this time around. Okay, but we needed to have an idea before we get into that exam. So thank you very much for staying tuned with me and with FCA. I want to believe you enjoy yourself, and there's no question for me. Okay, thank you so much. I'm going to see you the next time. Like I said, keep reading. I'll try tomorrow to get all what we plan to cover. Get the notes either tomorrow or Thursday. You have it so that you can start reading. So when we meet, it will be easy for us. And in the last week of the exams, just be prepared for extra classes in case we are not able to cover what we plan, so that we can use Saturday night and maybe Sunday night to really cover up. So I want to wish you the very best. So take care of yourself and have a wonderful night rest. For people that are taking SFM, you can take some breath and you come back online. Thank you so much. Enjoy your night rest. Thank you.